Welcome to Quick Bite, your fast and friendly Florida insurance update.
Hello. This is Roshonda, agency owner of the Isom Insurance Group here in the sunshine state of Florida, back again with another Quick Bite episode, your fast and informative insurance market update. Today is Monday, January the 26th, 2026. Oh, 26 and 26. Wow. um, and we are officially closing week 2 of Florida's 2026 legislative session. Week 2 is where legislation sounds good on paper. Week 1, I'm sorry, is where legislation sounds good on paper. Week 2 is where those ideas start getting tested in real life. This is the point in the session when committee members start asking tougher questions, industry experts and consumer groups push back, and lawmakers begin to see which proposals are easy to talk about and which ones are harder to implement without consequences. So today's episode is not about predictions or talking points. It's about what actually happened during week 2, where resistance showed up, and what that tells us about where Florida's insurance related bills are truly headed. Let's get into it. There was a noticeable shift in tone during the second week of session. Week 1 is about momentum, week 2 is about reality. Instead of broad promises about fixing Florida's insurance market, conversations moved forward moved toward practical concerns. Lawmakers begin asking who absorbs risks during transitions, how costs actually move through the system, and what unintended consequences might appear months after a law takes effect. And that's really cool to kind of know that's kind of they're weighing all the pros and cons. They're not just trying to put in a law. They're looking at the consequences of that law. In committee rooms, witnesses were pressed with questions about what happens if a proposal does not work as planned, who pays when coverage gaps appear, and how consumers are affected 6 months down the road rather than on day one. That change in questioning matters because it separates bills that are structurally sound from bills that still need serious work. Auto insurance was where the tension was most visible during week 2. As you know, we're still they're trying to repeal PIP or no fault coverage. So the personal injury protection repeal bill, Senate Bill 522 and House Bill 769, are still sitting in their first committee stops. The Senate version remains in the Banking and Insurance Committee, while the House version is in the Civil Justice and Claims Committee. During week 2, organized resistance became more apparent, particularly from medical providers. Their concern is straightforward. If $10,000 PIP layer disappears, they worry that emergency rooms will be left with unpaid balances, that care approvals could be delayed, and that costs may simply be shifted elsewhere without appearing clearly on an insurance bill. Many people don't know, but with PIP, there are a lot of rules that come with that. Like the insurance company, when they get a medical bill, they only have a certain amount of time to pay it. And if they don't pay it within that certain time, these providers will charge interest on the bill. And the insurance companies still have to pay that and plus the interest. So of course, the medical providers are going to be the first ones that go against it. Supporters of repeal are not backing down, but they are refining their approach. They continue to emphasize that proposed January 1st, 2027 effective date, which has become central to the bill's survival. That later start date gives insurers time to reprice risks, agents time to educate consumers, and drivers time to adjust coverage. At this stage, the bill is not stalled, but it is clearly being stress tested. This is the kind of legislation that will be decided by committee details, not by speeches on chamber floors. Property insurance remains front and center, of course, especially when it comes to citizens. House Bill 909, which proposes increasing the citizens' dwelling replacement limit from $1 million to $1.5 million in counties with limited private market competition. The bill continued to move through the Insurance and Banking Committee during week 2. Support for expanding access remained strong. However, the focus of the discussion shifted from access to exit strategy. So again, I can understand this because again, citizens is meant to be the insurer of last resort. So they don't want to take on more of the private market by making the limits higher. But the problem is in those areas, they don't have much access to private market. A lot of carriers still aren't writing in those areas. And those houses tend to be, need higher limits. So who else is going to do it if citizens doesn't do it? But I get it. They don't want that, they don't want that part of the market sitting on their books for a long period of time. They don't want citizens to come too big again. So lawmakers spent significant time debating the 10% annual rate cap in those non-competitive counties. Some legislators see the cap as a necessary shield to protect homeowners from sudden premium spikes. Others worry that it could reduce incentives for private insurers to return and could keep higher value homes and citizens longer than originally intended, just like I said. So it's like a balancing act now. At this point, the debate is no longer about whether citizens should step in. It is about how difficult it should be to step back out. Again, they don't want to be on that. They don't want to get citizens too big like it was before. They're really trying to shed policies out of citizens. So they're not trying to make any legislative rules or laws or any statutory laws that will affect and make citizens be, again, the bigger insurer in the market. While some bills slowed under scrutiny, others continued to move quickly. Legislation addressing artificial intelligence in claims handling remains one of the clearest examples. Senate Bill 202 and House Bill 527 continue to advance with little resistance because of their straightforward approach. Artificial intelligence may assist in processing claims, but it cannot make final decisions on its own. Any denial or reduction must be reviewed by a qualified human professional, and that person must be identified by name. House Bill 815, which addresses roof life. Let me go back to the artificial intelligence bill. I really feel like this is one of the bills that's gonna just breeze right through because it's common sense. We always want a human to be the final arbiter of making a decision. We don't want artificial intelligence making those decisions because they're basically, interpreting the claim, interpreting policy language, interpreting the estimate or the damage reports in the appraisal reports and making a decision on that. I believe they can get, artificial intelligence can be a tool in that process. But I do strongly believe a human should always make that final decision because you don't want to be just denying claims. You want to pay your claims that are old. You don't want to not pay claims. So it should always be a human that has to make that decision. House Bill 815, which addresses roof life and renewals, also continue to evolve. The core protection remains intact, meaning a policy cannot be denied solely because a roof is older if it still has at least 5 years of useful life remaining. However, week 2 introduced new discussion around pricing. Insurers are exploring amendments that will preserve coverage eligibility while allowing price adjustments for older roofs. This signals a shift away from all or nothing underwriting toward more nuanced risk pricing. That's kind of a neat turn on that bill. That's kind of interesting. One of the most consequential developments in week 2 did not involve premiums or coverage limits directly, but it could have a significant long-term impact on insurance costs. House Bill 1157 or 1157, filed by Representative Basby, and Senate Bill 1396, 1396, filed by Senator Burton, officially hit the committee floor. These bills are known as the Litigation Investment Safeguards and Transparency Act. And in my prior video about the legislative session, I had no idea about this bill, but it did come on my radar when I was reading an Insurance Journal article. So this one is kind of neat. They target what is commonly referred to as lawsuit lending. Lawsuit lending occurs when outside investors fund a legal case in exchange for a percentage of the settlement. So I don't remember if you remember back in the day, it was a whole bunch of commercials on TV, and they were talking about if you need money now, cash now, you got a settlement pending, or you got a case pending, get cash now. I forgot the catchy phrase, but that's what this is. This is what this is targeting. This is interesting. So supporters of the bill argue that this practice can distort the legal process by allowing investors rather than plaintiffs to influence strategy in pursuit of higher returns. Yes, I completely agree with that, because what was happening is you as a claim adjuster, you can have your claim pretty much, settled. But then the attorney's coming back, and because they got this loan from this investor, that their client got money before the settlement, they got to get more money because their client wants to take home a certain amount of money in their pocket, but they got to pay that settlement money back. So now if you had a claim settled for $10,000 and you were ready to go, but then they find out about this other $5,000 they got advanced, they're not going to settle for 10. They want to settle for 15 because they now want you to cover that advance that their client got. Yeah. The proposed legislation aims to ensure that the homeowner or driver bringing the lawsuit, along with their attorney, remains in control of the case. The bills would prohibit financiers from making decisions about legal strategy, selecting expert witnesses, or choosing specific attorneys. They would also cap profits so that an investor could never receive a larger share of the settlement than the plaintiff receives after attorney fees and costs are paid. I like this one. Another significant provision requires mandatory disclosure if lawsuit funding comes from a foreign entity or sovereign wealth fund. I didn't know. I didn't know foreign entities were involved in this. That information would need to be disclosed to the court, all parties involved, and the Attorney General. The bills also prohibit financiers from paying referral fees or kickbacks to attorneys or healthcare providers. Opponents, particularly trial lawyers, frame this as a David versus Goliath issue. They argue that without litigation funding, individuals and small businesses cannot afford to fight large insurance companies. As of week 2, House Bill 1157 was referred on January 15th to the Civil Justice and Claims Subcommittee and is awaiting its first hearing. Senate Bill 1396 is moving slightly faster. It was introduced on January 22nd and has been placed on the Judiciary Committee agenda for a hearing on Tuesday, January 27th at 1 p.m. This is a bill worth watching closely because it goes to the heart of how claims are litigated and how costs ultimately ripple through the insurance system. I'm interested in that one. Some of the most meaningful movement during week 2 came from quieter affordability-focused proposals. Senate Bill 1476, which would require mandatory claim-free discounts, officially moved to introduced status. The proposal would require insurers to apply a minimum 5% discount after 3 claim-free years, without disqualifying policyholders for storm-related claims. While it's still early, this bill is noticeable because it rewards long-term behavior rather than reacting only after losses occur. I like that bill. House Bill 1399, which focuses on affiliate transparency, also gained traction. Lawmakers are increasingly questioning whether payments insurers make to affiliate companies are truly fair and reasonable. After a profitable 2025 for many insurers, legislators are seeking greater visibility into how those profits are allocated. Property tax relief for insured homeowners remains a popular idea as well. During week 2, the House amended the proposal to delay implementation until January 2028 to give counties more time to adjust budgets. The concept remains appealing to voters, even if it is a longer term play. As we head into week 3, several themes are clear. The PIP repeal effort remains active but divided and heavily under scrutiny. The citizens' expansion proposal continues to move forward, but with increasing debate about long-term structure. Artificial intelligence projections and claims handling are advancing smoothly. Roof life protections are shifting toward pricing discussions rather than eligibility fights. Litigation funding reform has officially entered the conversation, and affordability measures are gaining quiet momentum. Week 2 did not resolve these debates, but it clarified them. I will continue to monitor these bills closely, especially for late file amendments and strike all rewrites, which often appear quietly and change everything. If today's episode helped you understand what really happened during week 2 behind the headlines, now is a great time to stay proactive with your insurance planning. If I could speak, legislative moves slowly until it doesn't, and preparation always beats reaction. If you found this quick bite helpful, please like this video, share it with someone, a friend, a friend, family, or relative, or family and relative are the same, or drivers or anyone in Florida or beyond. Drop a comment below with any questions you would like me to cover next. Quick Bites. Remember, Quick Bite episodes drop Monday, Wednesday, and Friday at 2 p.m. Eastern. This video is for educational purposes only and should not be taken as legal, tax, or specific insurance advice. Please consult a licensed insurance professional regarding your specific situation. This is Roshonda with the Isom Insurance Group here in sunny Florida. Thank you for watching. I'll see you next time. Please stay safe out there. Bye.
Thank you for watching. Visit us at isominsurancegroup.com.